Major funding for these broadcasts has been provided by grants from New York Community Bank, AmTrust Title Insurance Company, Perfect Building Maintenance, M&T Bank, Customers Bank, Marks Paneth LLP, Ariel Property Advisors, Sterling National Bank, Capital One Bank, Collins Building Services, Meridian Capital Group. Additional support has been provided by grants from AVR Realty Company, Amerant Bank, Bank of America Merrill Lynch, B6 Real Estate Advisors, Briarwood Organization, Chase Commercial Term Lending, Chase Commercial Mortgage, Citizens Bank, CPEX Real Estate Services, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handler Properties LLC, Handler Real Estate, Hodges Ward Elliott INC, Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, Kilroy Architectural Windows, New York's Window Company, Matone Group, New Banks, Newmark Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Rockefeller Group, Rosewood Realty Services, SJP Properties, Stonehenge NYC, TD Bank, Terra CRG, the Meringor Family Foundation, and these friends. Everybody wants to own a piece of the apple. People want to be owning real estate in New York. But what's truly happening with investment sales? The comment is, there's certain potential regulation in Albany. There are the markets, the stock market is changing. The capital markets are there. I don't really know the answer. So today I've assembled this group of investment sales leaders to provide their insight on the market. My guests, they include Shimon Shakuri, founder, president, and CEO of Ariel Property Partners, Helen Wang, Executive Managing Director at Meridian Investment Sales, and Dan Parker, who is the Managing Director at Hodges Ward Elliott. So it's mid-year. Where do you see the market? Is it a good time? Is my apple bright, or is it not, Mr. Shakuri?
So the first thing is your apple is always bright because it's New York City. In terms of capital, there are a tremendous amount of investors who want to place here. The question they ask is, what do we see today and what kind of uncertainty we're facing? So statistically, we've seen that the multifamily market and general investment sales market had less transactions in the first quarter of 2019 compared to the fourth quarter of 2018. Multifamily specifically went down 50%. You mentioned rent regulation. Everybody's expecting to see what Albany is going to come up with mid-June, and that puts a lot of investors and owners on the sidelines when it comes to the multifamily asset class. Other asset classes are doing pretty well, especially land in the boroughs for different reasons, including rezoning initiatives that took place and including the relatively new OZ Opportunity Zone that a lot of people are talking about and now transacting with.
Everybody thinks the industrial market is great, which it is. You've been doing things in Long Island City.
I mean, there's still a lot of interest, and there's the thesis of industrial still feels like it has a lot of traction. But you do have a number of investors who have gone into the space, and I think you've got, we sometimes in New York will see an opportunity that we need, 10 operators or 10 industrial deals, and you'll have 100 guys doing
in a similar manner. Over the last couple of years, a lot of industrial space was converted to office space, with the hopes that that would be very chic and very unique and everything, and they took space that used to have a 7% loss factor, and they now wrote it to 28%. Some of those buildings, especially in Brooklyn and in Queens, are not doing that well. I know you've been active in the office market. How do you see the office market?
I think office market is very healthy. There seems to be a good balance between demand and supply. If you look at the market overall and sort of track what's getting done in the market versus what's not selling, because as you know, a lot of deals that come to the market don't necessarily trade. In the office sector, it's been very, very healthy. Only about 18% have not been trading, and about 80-some% has been trading. And there's been a good balance between value add, core plus, versus residential sector, where about 60% of the deals that come to the market do not trade, and most of which have been very core specific assets. And although we're talking about rent regulations and how that's impacting the multifamily sector, the value add sector has been very, very robust in the residential sector.
Now, you were mentioning something about the industrial market. It's important to say that over the past decade, 1 million square feet was taken out of the market in the form of rezonings.
Right.
And so that created a supply constraint. And with now the new need for last mile innovation or storage, we have different companies going to the South Bronx and buying, Blumenfeld is one of them, or to areas in Brooklyn and converting existing industrial to that. So it's important.
You bring up the South Bronx. When you pick up the press or read other things, everybody's talking about the Bronx. How do you see the Bronx? Is it much stronger than it was over the last couple of years?
Yeah, very strong. I think the Bronx thesis, the Bronx idea is very exciting to a lot of people. I think that where things may have slowed is in the rent regulation uncertainty, and a lot of the housing stock of the Bronx is regulated. But the desire to build new construction in the Bronx is very exciting. You've got, Lightstone recently is making plans to build 3,000 apartments. That's on top of Brookfield's really exciting project. There is big investment going into building new housing stock in the Bronx, and that's going to bring retail, that's going to bring different demographics of incomes, and I think it's really driving a lot of interest in the product.
I completely agree with that. I think that also you have to look at the South Bronx as a real opportunity place in terms of building new residential apartment rentals, because you have the affordable New York, which allows for a great abatement there. You have the transportation. You also have it in opportunity zones. So what Brookfield is doing, what Domain Properties, the bought from Treetop is doing, bought for $130 a buildable foot, is something that you've heard about over the past 5 years, and is probably going to happen in the next 5 to 7 years. So the South Bronx is going to change from a neighborhood with land to a neighborhood of residents.
It's also a function of land pricing.
Correct.
I think everybody's been focusing on workforce housing, and there aren't that many places in New York City where you can buy land to do workforce housing. I think it's a function of pricing that people ended up there, but the fundamentals are also very strong.
There's a lot of areas. Queens has great transportation also, certain
100%.
Yeah, Long Island City, tying Long Island City to the Bronx is kind of interesting, because Long Island City proves that a neighborhood that didn't exist a decade ago can actually rise with new construction, that people will move there and want to live there. And there's still room to run in Long Island City with the retail and all of the amenities. But I think a lot of people have tied the success of Long Island City to, okay, that's what's going to happen to the South Bronx. And I think Long Island City is a great success.
How do you look at the development sites for condominium development? Because condos, by many lenders are skewed. They don't really like looking at the condo. Have you?
Every land that we're looking at or marketing today, about 80 or 90% of it is looked at as rentals. Again, going back to affordable New York, which allows allows you to receive the tax abatement, and also if you're in opportunity zone in the boroughs, it helps your capital.
But there is still, as one would say, the American dream to own your own piece of the rock. Okay. To own an apartment.
There's just so many apartments on the market in the condo sector that are not trading, and those are on the higher end of the market for sure. But I think it's a hard story to tell right now if you're an investor and you're going out and saying, I'm going to develop a new condo project.
You brought up before Long Island City, and one of the markets, Long Island City has 14,000 new units coming on board over there.
Yeah.
but most of them are rentals.
Right.
The condos, you know, that the CUNY has built and certain other people have done relatively well in Long Island City.
Look, I think the job market of New York City supports multifamily all day long. And then the reality is that the tech market has created enormous, even without Amazon, New York City is creating jobs at a rate of like 13 per hour.
LIC's story in terms of condo, it's really going back to the fundamental pricing point story about the condo market. So anything above $3 million has been just getting stuck. You don't see much of absorption in that market. But smaller units and lower pricing point units have been moving actually very healthily. Like we are about to hit the market with a development deal that's boutique in nature. And even before our listing was signed, we got about 20 phone calls from developers pounding like our doors to get that deal. So I think depending on which submarket it is, and whether it's boutique in nature or very large, and whether you're sort of targeting the larger pricing point unit side or not, I think there's still much demand for condo products.
You know, to this point, I think if you have what we call affordable condo projects, people are going to look at it and consider it, be it Long Island City, be it Harlem, be it Brooklyn.
You know, and I think it's also neighborhood centric. You know, the
For
condo
sure.
developments on like where you are on the Upper West Side. People, you know, there's a limited number of condos.
Right.
Their families want to be there. The schools are there. The community is over there. The houses of worship, and they keep them busy. Similar manner in the Flushing neighborhood over there, with the Asian communities wanting to be there, and those condos have done rather well in the market. You guys are specialists in hotels, okay? How do you see the hotel business in light of Airbnb and in light of the New York City regulations, the new regulations that you have to go for special permits and so on?
So I think probably one of the biggest movements in the hotel market, and just to be fair, I'm not a hotel
I realize,
specialist,
but I know your firm is.
I'm around it, and you know, I think some of the changes to the way M zones are going to allow hotels is going to really put a constraint on new development. The Sam Chang Hotel was built on the back of M zones allow for mid-block hotels, right. And that's going away. And so with those zoning changes, I think you're going to see a real supply constraint of new construction on hotel.
You know, one area that people are talking, and I don't believe it's fact, is that retail is dead. And then, you know, you walk around and you see many of the Warby Parker, and you see the Bonobus, and you see the Jack Irwin, and all these other e-commerce sites have become today brick and mortar sites. How do you see the retail investment sales today?
I think the retail market is very tricky because it's still evolving. I think if you speak with a lot of tenants, if you speak with a lot of leasing brokers, they'll tell you they still don't have it figured out. It's extremely difficult to move retail assets that are large. And you know, anything above, say, $40, $50 million is very, very difficult. We're about to sign a deal that's about $20 million, so a bite-sized retail deal, and I will tell you it was very difficult to move it. I think investors are focusing on more of the service-oriented retail, more neighborhoody retail, and they prefer multi-tenanted retail versus single-tenant with more tenure. And they want to make sure that the rents are at market because there's less clarity on certain markets what the true market rents are. And I think that unless you're in that neighborhoody markets, for high street retail, I think it becomes really challenging to really understand whether your in-place rents are at or above. Yeah. And that's what's making it challenging to move larger deals.
I think in the Bronx and Upper Manhattan, for example, is actually somewhat of a strength in the retail.
Because of the population increasing.
Correct. And the expectation of cap rate is met by the sellers usually, so you get a higher cap rate there comparatively speaking. What's also interesting is some smaller multifamily owners, when I say small, they could own 1,000 units, but they're not institutional, held by institutional capital, are now moving into some commercial. So if they own in the Bronx or if they own in Upper Manhattan, certain areas in Brooklyn, they say, you know what, we want to look at commercial in general versus residential, and that helps retail and office in general.
Are we seeing a lot of foreign investors coming in? Or are we seeing domestic investors? Or are we seeing, in a similar manner, the private equity funds being stronger?
So I think on the office front, we're seeing foreign. We're signing a deal with a foreign investor on a Midtown office building. On the retail front, just kind of touching back on that, we signed about a $90 million deal, and I completely agree with Helen that it is tough to get those deals done. I mean, they're signing in, low 5 caps with fantastic tenants, long-term tenancy, leases, credit, everything is lined up, and that would have traded, at least 50 to maybe even 100 basis points lower 2 or 3 years ago. And so it's the market has changed. I think in terms of the investor pool, on the multifamily front, the foreign investor kind of gets a little skittish in our experience with the rent regulation uncertainty. So
yeah, multifamily has been mostly domestic capital, although we're seeing new players in the multifamily world. We are closing on a deal next month, roughly $160 million, and that deal is funded by a European pension fund. So we are seeing, and also we're seeing some Middle Eastern investors in the multifamily side as well.
Yeah, I think the foreign investors never left the market from our perspective. They became a lot more sophisticated, especially when it comes to multifamily. Can tell you that they're looking to come back once there's clarity after the middle of June. A lot of the small to mid-sized investments, let's say up to $100 million, were fueled by a lot of investors from Europe and from Israel and from other places through local operators when it comes to multifamily in New York City. And again, these are sophisticated investors that are looking to come back once they understand what the regulation means.
When we talk about the city and we talk about the boroughs, many people omit the fact that there is a 5th borough that you have to reach either by ferry or by bridge. But they just recently opened the Empire stores in Staten Island. Do you see anything happening in Staten Island?
We got some requests to look at some land there, land valuations, etc. I think that borough will take a turn to the better probably in the next few years, but it's still, there's not enough velocity there of investments to talk about. So, but I think it's going to happen in about a year or two.
Yeah, you're seeing a lot of good anecdotes, a lot of good public and private investments into Staten Island. I'm no by no means expert in that area, but we did move a fairly large site in Princess Point for us to a local developer. It's a very local development market. It is highly political market, and I think that also deters a lot of the traditional New York developers from entering. But it's definitely a market with a lot more upside as we see it.
Right. As my friend Josh, it took 40 years for them to sell the property.
Exactly.
It took a little while for that.
It takes a little while.
You were talking about New Jersey. What's your thoughts about investment sales in New Jersey?
I think New Jersey has been very, very active, and many investors in New York, especially in the multifamily sector, have been looking outside of New York City because returns have been very, very thin. That effective rents have been sort of flat for some time, and in order to find yield, a lot of the New York investors have been going outside, and I think New Jersey has been a good market for them to look, and we're seeing some good deals getting done there. I think fundamentals are strong, especially in Jersey City area. A lot of new developments going on in Jersey City and Newark. So things look pretty positive.
But Jersey City is like a tale of two cities also. If you're at the right specific
That's
location,
right. It's spotty.
You can get a $50 rent.
Right.
Otherwise, if you go to McKinley Park, you're at $30. It's a different thing. And it's also if you're near the light rail. But one area which I think is growing very well, especially in Westchester, is the transit-oriented developments. Because anything that's near the train, especially that Grand Central is going to have both the Long Island Railroad and Penn Station, both the railroad and Amtrak, it's really valuable.
RXR's, really had a vision for
New Rochelle,
the New Rochelle market,
market.
And really saw an opportunity to help plan a master plan and fund that, and that met a real big need. And now those neighborhoods are going to have thousands of new apartments over the next decade built.
I think you're right. I mean, Westchester in general is just a market that a lot of investors are going to, New York investors are going to today. We did a joint venture deal in White Plains last year. We brought one of the local players from here there, and we're doing a capital raise for a $100 million project in Ossining. And I think that investors see the opportunity outside of the city more so than inside the city today as well.
Two areas in Brooklyn that really haven't seen a resurgence, but there is some development taking place, is both Coney Island and East New York. And I know you have people who operate running that area. How do you see those markets?
Yeah, so if you ask our brokers, Coney Island is going to take off probably now. Remember that a lot of that land is opportunity zone, so that really gives someone an opportunity to go and build there now or sell.
Right, and now that they have the ferry is going to be stopping in Coney Island,
right,
which will increase the situation. What about East New York?
East New York has some benefits to it as well from an opportunity zone perspective and from an industrial perspective. So these are the two items that I see could be an advantage for that location, but it's still, it still has ways to go.
Far West Side, now that Hudson Yards is open, where do you see that market?
Continuing to mature. I mean, it's we've reached the critical mass. We've reached everything that's exciting. I think there's some big announcements coming in that market as well. Now that Hudson Yards is completely open, I think there's going to be some more announcements coming about big leases, and it's going to be pretty interesting to see sort of how the derivative of that is the Queens market, because you've got all that connection to the transportation, and I think Long Island City commutes very well to those markets.
I'm not less excited about Midtown East, by the way. I mean, One Vanderbilt is going to do pretty well, and
One Vanderbilt, the
JPM,
JP Morgan, Grand Central, the Grand Hyatt's going to be converted.
Right.
There's potential with the Pfizer building now that Alexandria, and that relates to the fact that part of something of Long Island City that we didn't discuss is the life sciences that taking place. The fact that Alexandria bought one of the industrial spaces, and life science is growing, and healthcare is growing all over in the marketplace over here.
Absolutely. I mean, we were involved last year in capital raise for a 350,000 rentable square foot spec office in Upper Manhattan that's going to build the office for life sciences. And we raised $100 million from JP, and that's just by Columbia University. So that trend will continue, and the city encourages it.
Was that the Tasty?
Yes.
Yeah.
Right. Because of what happened with Columbia University taking over that portion of that market. With regard to that, where do we see the three Harlems, as I would say? There's West Harlem, which is the most beneficial, Central Harlem, and then East Harlem. East Harlem has had the rezoning. What do you see happening over there?
Look, the rezoning is interesting because I think the city did a clever thing. They upzoned on the one hand, but they put a mandatory inclusionary housing, which then forces you to build mandatory inclusionary housing at a 20, 25 to 30%, depending on your AMI brackets, and that really lowers the value. So essentially, if you wanted to sell land today versus land before the rezoning, it's more or less the same price, which again is pretty clever from the city's perspective. We're selling a lot of land today in East and Central and West Harlem. It's selling, anywhere in around the 200 plus minus a buildable foot. Some of it is for condos. Much of it is for rentals.
What about the Gowanus? Everybody talks about the Gowanus.
So Brooklyn, Gowanus, another market is the Navy Yard, right? I mean, the Navy Yard feels like Gowanus or Bushwick 5 or 10 years ago. And we saw how Gowanus changed when the Whole Foods arrived and the neighborhood surrounding it.
Right, and the Navy Yard, you have Wegmans opening up in September.
Wegmans is going to be a total game changer for the Navy Yard. There is people that are extremely excited about the arrival of Wegmans, and that's going to change that neighborhood. There's a ferry opening up. You've got Dock 72 that's opening with WeWork leasing a third of Boston Properties asset there on the water. The Navy Yard feels like, it's an entirely jobs-driven story, and there's very little multifamily that can be built because of the M zone and the IBZ.
Right. The biggest problem about the Navy Yard is the fact that it's good that they're going to have a ferry, but the transportation is poor.
Right, but that's the question on the mind of the 20,000 people that are going to work there. Where am I going to live? And so how am I going to get to work every day? And so I think the Clinton Hill market.
Clinton Hill is a very strong market.
Fort Greene.
It's going to be stronger because of the Navy Yard over there.
I agree.
Because, as you say, Dock 72, which is a 1 million square foot, and the the property that Boston Properties over there.
Building 77 and Dock 72 are the
Right,
two
you know,
major.
that's 670,000 square
And you
feet.
have RXR's project that's outside of the Navy Yard, but keep your eye on the Navy Yard. It's going to be exciting.
Back to the Gowanus, the zoning is going to be good for it, although it still has MIH, and mentor inclusionary housing, and there's some opportunity zones there too. If you ask Sean Kelly from our office, he's going to jump on every property that comes up in the Gowanus. He loves it. He thinks it's the next best thing that's going to happen. So definitely put an eye on it.
So in summation, what do you feel that how's the next 6 months look?
I think it's certainly in the multifamily sector. I think June 15th, come June 15th, a lot of sellers and buyers will make their decision, whether to sell, whether to hold, whether to finance, whether to buy. So I think there's going to be a lot more movement in the multifamily sector. I think office will continue on, and retail will continue on as well.
Dan?
I think the free market buildings that are not restrained by rent stabilization are going to become increasingly valuable. And it's actually going to take a little bit of time for the market to digest the rent regulation reforms.
Yeah, I agree. I think it's going to take time for people to digest. I can tell you that we're getting a tremendous amount of requests for valuations right after June 15th to talk about what it means. I agree with you. There's going to be a lot more velocity before year end and in 2020 with regards to selling.
So my apple, which is shiny, continues to be shiny. And I'd like to thank Shimon, Helen, and Dan, and I'll see you next week.
Thank you.
Thank you.